Hello, good afternoon, everybody. Welcome to today's session. Today we will continue for the same where we just left yesterday. Sir, you can just start. Okay, many of have joined and some others will join by the time. Okay, you can just start
Okay.
from today. And sir, I
Yes.
mailed you two questions yesterday that were placed by our audience.
Okay.
So if
That
you
two
just
questions
could,
along with yes. Any other questions in our
uh,
question and answer chat box also
sir.
would be discussed at the end of session.
Right, sir. I will
Hope
just,
it would be.
yes, it will do, sir. I will just mail you if there is any more questions today. Okay.
Okay. Okay. So thank you, Debabradada sir. Thank you, TRD. Very good afternoon to you all the August audience who has assembled here as part of second day ICDS standards with relating to inventory valuation assigned to cost accountants. Today being September 5, Happy Teachers Day. Our prayers, our regards to all the teachers who made us to be in this point, and Happy Teachers Day to all the teacher faculties within today's attendees also. So yesterday we were discussing about ICDS 2 in particular, how to value an inventory with regarding to ICDS 2 we were discussing. So in ICDS 2, just for a quick recap, yesterday we were discussing para 3 of ICDS 2 speaks about the measurement principle. With regarding to measurement, two technical terms, cost or net realizable value, whichever is lower, shall be the value of inventories we were discussing. Then we went on to discuss with the term cost. The term cost comprises of four elements we were discussing. Cost of purchase, peculiarity of that term, cost of purchase inclusive of duties and taxes, even though it is recoverable, we were discussing. Then we went on to discuss with cost of conversion. Then with regarding to that peculiarity in this ICDS standard regarding cost of service also. Plus other cost including borrowing cost we were discussing. Then various methods adopted in order to value the inventory, stock, may it be FIFO, LIFO or FIFO or weighted average specific identification, standard cost method or retail method. All those methods we were discussing separately and we were illustrating via small examples also. Then we went on to discuss with change in inventory policies, if any, and difference in profit, impact on profit due to that change in accounting policy were also being discussed. Plus, at the time of dissolution, how the inventory has to be evaluated as per ICDS standard. All those things we were discussing yesterday. So at the beginning, in the scope paragraph itself, we were mentioning that certain things which would be outside the purview of this ICDS 2 with regarding to work in progress on construction contracts, works contracts, all these things would be under ICDS 3. Then with regarding to shares, securities, all other financial instruments, separate standard is there, ICDS standard is there if it is held for sale. Then certain space, machinery parts were not being covered under ICDS 2. Plus agricultural produce, ores, minerals, natural gas, etc. were not also being covered under ICDS 2. In Form 6C, the form which is being drafted by the department, that form definitely, yes, we would be going through that form at the end of this discussion, this webinar. And in that form, if you go by, definitely, yes, separately for those inventories which are being valued under ICDS 2 as per ICDS 3, as per some other standards, etc., some other methods, etc. Separate columns are being provided. So box by box, column by column, we will be correlating all the things that we were discussing for the last 2 days, yesterday along with today, plus how we can fill that form 6C in E form we would be discussing. Yesterday, due to that question in that inbox only, I am telling this thing. First of all, the fundamental thing that the members should appreciate is this form 6C is the E form, electronic form that a cost accountant is supposed to submit before the assessing officer at the time of scrutiny. So we know the background we were discussing yesterday also. Section 142 2A was been inserted, or the section 142 2A has been inserted in order to have the assessing officer an option to give to assign to a cost accountant in order to value the inventory, so that that actual valuation as per 145A or ICDS 2 can be derived via that valuation. There are certain things which are still missing here in form 6C. Definitely we would be discussing those points also at the time of discussion. And the August audience also can raise their own concerns with regarding to that form 6C. Why? Because it is in its draft form. And we are the people who are being entrusted in order to report via that form 6C. So those practical intricacies which we are feeling, definitely, yes, you can throw it in that inbox we would be discussing in this forum. Plus, we can definitely report, or we can suggestions can be forwarded to the institute, as well as we can directly move on to the department, income tax department itself. So in that form 6C, the basic thing that we have to presume is that form 6C, how much frequency we have to submit was a basic question. So from which I want to make it clear that that form 6C has to be submitted only when it is been assigned to you, that assessee's inventory valuation. After doing the same, you would be allotted with 2 months, 3 months, etc. And after that period, we would be required to report to assessing officer to the faceless assessing authorities via electronic form. That electronic form of 6C has to be submitted only once while reporting the inventory to the department. Bus. So how these ICDS2 sort of inventories to be reported, how construction contracts to be reported, how agricultural products to be reported, everything we would be discussing while going through that draft form 6C. So yesterday, as I mentioned, we were discussing about ICDS2 standards, element wise, how we would be doing cost of purchase by inclusive method, etc. We were discussing. Now, after that ICDS2 discussion, let us first compare this ICDS2 with that of concerned AS2 as well as Ind AS standards. So for which I am trying to share my PowerPoint presentation. Hope it is visible. Devabrata sir, hope it is visible. PPT. Hello. Am I audible? Hello.
Yes, sir.
Yes. Hope it is visible.
Yeah, it is visible now.
Yes. Sorry. The thing is actually without which actually I cannot get any feedback, because the audience are not having that opportunity. That's why.
No, yeah,
Anyhow,
sure, here.
okay. Income computation disclosure standards. We were discussing ICDS2. Then we are comparing that ICDS2 with that of accounting standard number 2 with that of Ind AS number 2. Why this much relevance? While comparing AS2 with that of Ind AS2 is the point that we have to make it counted is, as we know, this ICDS2 is only for the purpose of income tax computation. Yesterday also we were mentioning the same. So just for the purpose of income tax computation, ICDS2 is being followed. So in the books of accounts, the electronic way of bookkeeping, if they are doing in their sort of electronic software, may it be SAP, may it be Tally, whatever software that they are using, that software would be having that books, that inventories to be valued as per AS standards. In case wherein it is being made applicable, corporate associates who are having that Ind AS applicability, it would be par with Ind AS 2 standard. So first and foremost thing that a valuer, that the cost accountant at that time have to evaluate is how come their books of accounts maintained this accounting standards have got distinction from the income tax requisite standard, that is ICDS 2. So for which only that comparison, point by point comparison also we were making it yesterday. Here in nutshell, what are all the important distinction? What are all the critical differences between those ICDS 2 standard with that of AS2 as well as Ind AS2 we would be discussing right now. And we know at the time of inventory valuation, there are no specific instructions from the income tax department if you go by form 6C to have physical verification of inventories. There are certain columns that where we have to report whether there are any quantitative differences. As per my limited information, kindly do correct me if I am wrong. There are no clues wherein we have to conduct physical inventory verification. So in that cases, the thing that we have to do is we should have to have the access to the books of accounts maintained by the assessee, wherein definitely yes, they would be maintaining the books of accounts either as per Ind AS standards or as per normal accounting standards. So that accounting standards stock valuation, we have to compare with that of their tax audit report. We know the tax audit report comprising of 3CA for corporates and any other entities whose books of accounts has to be audited by some other statutes, companies, LLPs, societies, etc. Plus 3CB in case of those who are not covered under 3CA. So that 3CA report or 3CB report along with that annexure 3CD. So quite an important annexure that the practicing cost accountant at the time of evaluation, the valuer for the time being, I would call them. The valuer have to evaluate is the valuer definitely at the time of valuing the same, how to go through that 3CD also annexed along with audit report. 3CD is supposed to be prepared by the assessee and the accountant, the chartered accountant who is going to tax audit it under section 44AB, how to give their opinion regarding the trueness and correctness or trueness and fairness of that report in respective 3CA or 3CB. So in that 3CD report, if you go by, there is a clause number 14, which is requisite in order to report whether 145A of Income Tax Act is followed or not. So that section 145A we were discussing yesterday, 145A after amendment in 2018 is now par with the ICDS 2 standards. Now such inventories has to be valued as per ICDS 2 or any other sort of standards as specified in ICDS 1 to 10. It was been mentioned. So if there are any deviation, if we are not following as per ICDS standards, if it is not been mentioned in 3CD or no mention in 3CD, anything mentioned in 3CD, if it is been mentioned in 3CD, we have to presume that that too belong to what? The ICDS sort of compliant figures. If the 3CD is silent, if the auditor have given the disclaimer of opinion in the form that the ICDS sort of compliance cannot be certified, cannot be opined due to various lacking information, non-supply of information from the assessee. If there's something which is in qualification in nature, which is in disclaimer in nature, then there is no other way other than that the valuer, the cost accountant have to go to the books of accounts in order to evaluate the same. At all these points wherein you are comparing the turnover reported by, in the sense, the inventory reported by the assessee with that of the inventory which are going to get valued there by the cost accountant as per these ICDS standards. First and foremost thing that we should have that bare idea where and all there would be the chance for differences for those standards followed by the assessee in AS2 or in AS2 with that of ICDS2. For that sake of clarity only, again, we are comparing this ICDS2 standard with that of AS2 as well as in AS2. So first and foremost thing we were mentioning in this AS2, in this ICDS2, there is specific cost of services sort of a point, even though there are certain dilemmas. There are certain dilemmas, tax experts also do acknowledge that this term cost of services is not that much clear. For what purpose it has been mentioned, ICDS 2 is not that much clear. For the time being, just by going through that definition, the labor portion, any other service portion, in order to make such a product would be termed to be as cost of services. That a point is missing in both AS2 as well as Ind AS2 standards. Then the second difference that we were mentioning yesterday too with regarding to that inclusive method of valuing the inventory. So inclusive method we were mentioning for cost of purchase all the taxes, duties, cesses, even though it is going to get recovered, has to be included while going through this ICDS standards, but which is missing in AS2 as well as in AS2. There are no mentioning that taxes and duty has to be included. AS specifically mentions that it has to be excluded while valuing the inventory. And we saw by doing this inclusive method and comparing with that of exclusive method, there can be the chances wherein there can be difference, either increase or decrease in profit. So that case, definitely yes, we have to follow this inclusive method while following ACDS2. If not been followed, we have to prepare that reconciliation table. In that form 6C, we would be definitely seeing how to report the differences between actually valued as per the valuer with that of books, with that of the inventory reported into income tax department by the assessee in their income tax returns. So that second distinction. Third distinction we were mentioning, we will be also discussing that borrowing cost standard today. In ICDS2, it is been mentioned that yes, it is not with regarding to borrowing cost. Sorry, other costs includable in value of inventory. ICDS2 doesn't specifically exclude distribution cost. So what is distribution cost? That can be packing cost, that can be a repacking cost. So all those things would be comprising of those distribution costs. In ICDS2, there is no specific mention that such distribution cost has to be excluded. So we have to presume that distribution cost other than that of selling cost. Selling cost is obviously yes, it is been excluded, but you have to distinct that term selling with that of distribution cost. In AS2 and Ind AS2, there is specific mention with regarding to that distribution cost, and then on both standards, both AS2 and Ind AS2 prescribes that distribution cost has to be excluded, whereas in ICDS2 there is no specific mentioning that you have to exclude what distribution cost, apart from which selling cost has to be excluded. So I was mentioning there is specific distinction between those two terms. Selling cost with that of distribution cost, packing, repacking, etc. can constitute towards distribution cost. So those things, there is no specific mention. If you are, then you can definitely yes, include while valuing inventory as per ICDS2 standard. Then there were specific mention with regarding to opening stock inventory valuation. Why? Because we know there is a matching concept. Matching concept. What is matching concept? If you are putting the figures valued as per ICDS2 for a closing stock alone, if the opening inventory has not been valued as per ICDS standard, then what would happen is there won't be any consistency. Say opening inventory valued as per AS standards, closing inventory only valued as per ICDS standard. Definitely, yes, there would be some disparities. Why? Because a lot of elements are being included, excluded. There are differences between the books with that of definitely yes, ICDS standard. So that definitely opening inventory sort of point is being focused in ICDS. No such provisions are being mentioned in AS2 as well as in Ind AS2, as well as I was mentioning the next point with regarding to interest and other borrowing cost. ICDS 9 talks about the borrowing cost point. Therein, literally and usually, yes, we know the books while valuing the inventory, the finance cost, the interest cost would not be included, at the time of valuing the inventories. But here it has been mentioned as per ICDS 9 borrowing cost. If it is specifically chargeable to the revenue or to the assets, definitely yes, it can be added along with the inventories. How to do it? ICDS 9 we would be discussing in later part of our discussion. But for the time being, interest portion, if allowed under ICDS 9, is being included while valuing the inventory as per ICDS 2 we were mentioning. But usually it is not covered. It is not covered either under Ind AS as well as AS2. No specific mention about including finance cost, interest, borrowing cost charges, etc. for inventory valuation as per AS2 as well as Ind AS2. Then the last and final one, in case of dissolution, we were mentioning there are no specific mention as per AS2 as well as Ind AS2 regarding the valuation for the dissolution purposes. Why? Because the accounting is for going concern basis. So there won't be any issues, any chances to discuss with how to do it on the time of dissolution. No specific mentions there. But in case here, there is mentioning in ICDS2 with regarding notwithstanding whether a business is discontinued or not, inventory on date of dissolution shall be valued at net realizable value is the point that is being mentioned in ICDS2, somewhat par with Ind AS2 only. But in AS2, there are no such a mention with regarding to that valuation of inventory in case of dissolution. So these are all the major differences, distinction between ICDS2 standard with that of AS as well as Ind AS2. Then I was mentioning in tax audit report, definitely yes, that 3CD, there would be a column wherein the aspects such as the accounting policies adopted to measure inventory, including the cost formula used, and the total carrying amount of inventories and its classification appropriate to a person. So this column asks the assessee while filing the income tax audit report to mention the accounting policy adopted in measuring inventories, including the cost formula used to be made there. If there are changes in cost method, then that changes has to be due to that decrease or increase in profit also has to be reported there. Then if 145A is being adopted, then there is a question in case wherein if that method of valuation prescribed under 145A and the effect thereon the profit or loss. Why? Because as I mentioned, 145A prescribes to follow with ICDS2 standard, and if the inventory valued as per, definitely yes, the inventory valued as per ICDS standard would differ from that of the normal accounting standard prepared valued the books, stock, inventory, whatever it is. So that in that case, the difference between ICDS2 valued inventory, 145A valued inventory with that of books inventory. So that opening stock, closing stock is there. We know the difference in opening stock. If there is an increase, there would be decrease in profit. If that opening stock decreases, there would be increase in profit, and vice versa in case of closing stock too. So that differences, opening stock increase, decrease in profit, closing stock increase or decrease in profit, that amount, that too, we know that inventories comprises of raw material, work in progress, consumables, spares, etc., 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 jigs, fixtures, etc. So for every sort of an item, if there are certain differences with regarding to this 145A valuation with that of the normal books of accounts, that impact has also to be reported in that 3CD. So at the time wherein the valuer has been appointed, valuer have to go through that 3CD report also, with which he would be having a bare idea how it has been happening there. Then he can start doing that valuation exercise. Then after which he can compare his valuation with that of 3CD valuation. As so the books, if there are differences between that book with that of his value. So this is the 3CD that has to be checked at the time of valuation too. Then after mentioning these differences, after mentioning to go by these 3CD, let's go and discuss towards those things that we were excluded at the time of discussing the scope for valuing the inventories as per ICDS2. One among the exclusions was with regarding to ICDS2, there are no mentioning to compute the value of work in process, work in progress of works contract costing. So in such contract sort of accounts, this standard ICDS3 speaks about how to value the contract cost. So some key paragraphs in contract costing ICDS3 we would be discussing, and finally we would be determining how to value the work in process as far as this contract costs are concerned. So who is a contract cost computing? There, if there are certain contracts being performed by the contractor, there for each and every project, every type of a contract, the contractor is supposed to get the profit, for which he is trying to prepare contract accounts separately for each and every contract. So certain contracts, we know that contracts can be for a single, more than a single year. So within a single period, we are not supposed to complete almost every contracts in that. So if any contracts for which the work in process are being there are various techniques as mentioned in ICDS 3 in order to compute the cost for such work in process, and such inventories also would be duly valued as such. So as ICDS 2 is silent with regarding to work in process valuation for this contract cost, definitely yes, we have to refer this ICDS 3 in order to find out how in case of contractors, in case of contract costing followers, how to value such things. Those things we would be discussing, for which the first and foremost term that is being defined under that contract costing being contract cost shall comprise of costs that relate directly to specific contract. That is, say there are 3 contracts for a single project, say project A alone, this much raw materials are being allotted, this much labors are being supplied, this much consumables are being there, this much direct expenses are being there. So those direct expenses which are being allotted towards that single project alone, point number A. Then we know there can be certain common sort of expenses also. In such cases, we have to use that apportionment criteria we have to decide, and on that basis, we have to divide, we have to allocate, we have to apportion such cost, and that portion which has been attributable to that project also we have to add. Then such any other cost specifically charged to the customer under the terms of contract. Apart from this thing, some other sort of licensing sort of some other statutory sort of things would have been charged there. That also, if it is been reimbursable from the customer, also has to be added. Then there is a specific mention about then again ICDS 9, again borrowing cost. If some loans are being availed for such projects, and if such are being qualifying asset as per that borrowing cost. What is a qualifying asset as per borrowing cost? We would be discussing later. So if it is a qualifying asset as per that ICDS 9 borrowing cost, that amount of borrowing cost also has to be included. So all these inclusions would be for your work in progress also, work in process also. So that thing, 4 elements: cost direct, cost attributed, any other cost specifically charged along with borrowing cost would be the total cost. Then on the basis of stage of completion only, work in progress would be evaluated. If both for revenue recognition as well as cost recognition, these formulas or these presumptions are being made with regarding to stage of completion. Stage of completion. What is stage of completion? Stage of completion of a contract decides how much revenue has to be considered for that period, how much cost has to be considered for that period. If it is been completed, done and dusted, entire revenue can be considered, entire cost can be considered in order to find out the profit. But in case wherein there are certain things which are in process, in progress, definitely yes, here comes how to calculate the stage of completion. If that stage of completion is less than 25%, then there won't be any thing which would be treated to be as in work in process and all. But if it falls between 25% to almost completed stage, then we have to compute how much percentage of total work has been computed, has been completed. For that purpose, that stage of completion of a contract shall be determined with reference to the proportion that the contract cost incurred for work performed up to the reporting date bear to the estimated total contract cost, or surveys of work performed or completion of physical proportion of the contract work. So on that basis, how much has been performed as per the estimated total contract, there would be some stages of completion. There would be certain stages wherein this much stage, this much percentage of completion would have been presumed as per the pre-written contract. So on those basis, we have to then, in case of government contracts and all, there would be surveys by the departmental officials on that basis. Or on that basis, physical proportion. This much square feet has to be built, this much hospital has been built and finished right now. On that basis, physical proportion also we can make the stage of completion. Very important as far as this inventory valuation is concerned. Why? Because on the basis of this stage of completion only, we would be computing the work in process value. When the stage of completion is determined by reference to the contract cost incurred up to the reporting date, then the contract costs that reflect the performed are included in cost incurred up to the reporting date. Contract cost which should not be included, which are to be excluded. So except these 2 points, all the other contract costs which are being incurred till date would have to be included, except contract costs that relate to future activity. So it's something which is going to happen in the future. Anticipated cost, estimated cost, it should not be included. Payment made to subcontractors in advance. Advance payment also should not be included. So apart from that advance made to subcontractors, apart from the payments which has not been made, which relates to future activity. If it has been accrued and not payable, not paid, it is payable, definitely as it is includable. But on the basis of futuristic activity, if it is something in provision has been provided, that amount should not be included. Plus advance paid to subcontractors also should not be included. In that way, the total cost we have to estimate for that work in process contracts. During the early stage of contracts, where the outcome of contract cannot be estimated reliably beyond the revenue, reliably the contract revenue is recognized only to the extent of cost incurred. Early stage of contract shall not exceed beyond 25% of state of completion. I was mentioning up to 25% of state of completion, no revenue would be recognized, only cost would be recognized. So that point, from that 25% from almost completed, we would be having that presumption of works completion proportion for those contracts 25% to almost complete stage only, not from 0 to 25%. Then how to value this work in process? single simple sentence being used, being that work in progress has to be valued for the cost till date. How to compute the cost? We were mentioning. All these costs we have to add, all these costs we have to exclude to A, B, we have to exclude all the other things we have to add. To that total cost for that a project, that to a project which is in progress, which is in process stage. So that progress, that process staged contract, the total cost less cost recognized as revenue. So any other cost which has been recognized as revenue, that proportion amount already has been debited to P&L account. That amount you should not be taken. But for such which are been in progress, for which the cost has not been recognized as revenue, by excluding the same, that differential portion would be treated as work in progress cost, and that amount we have to value for the purpose of inventories. It should be credited if it is a closing inventory. Same thing has to be debited as opening inventory for the next period. So a valuer who is going to value the inventories for a contractor. If such ICDS 3 is being followed, then you have to value the inventory to be the total cost till date. The total cost I was mentioning, the relevant paragraphs I was going through, rushing through though. That total cost of that work in progress standard minus cost recognized as revenue distincted. The distinction, the differential portion would be treated as the value of work in progress. The same has to be credited in case of closing stock in their contract account, plus inventories and opening also has to be done in the same formula too. So this is how it would be valued as per ICDS 3 standard, which was an exclusion from the scope, work in progress in contract. Then as far as the next exclusion is concerned, the next exclusion would be the shares and financial instruments. So what is the speciality with this shares and financial instruments? If we are holding such shares and financial instruments as an investment, then mark to market, etc. sort of concepts we would be using in order to value such shares, financial instruments. But if such shares, if such financial instruments are being made in order to resale, so such stock brokers, so for such persons, these shares, financial instruments would be their inventory only. It would be for their resale. So this ICDS standard prescribes how to value such shares and financial instruments, how to recognize it at the time of purchase, how to recognize it in the end, future recognition. So both standard for both the points at the time of purchase, at the time of recognition, as well as futuristic recognition during the closing, whatever it is, how to value are being specifically mentioned in this standard ICDS for shares and financial instruments. So on that basis only, in case wherein there are security dealers, share dealers, their inventories would be followed. In this form 6C, in case the valuer is getting such sort of share traders, etc., their inventories would be required to value as per this ICDS standard alone. And in form 6C, there are separate columns in order to give such values. How to value the shares and financial instruments if you go by security on only the relevant paragraphs I had copied and pasted. So I would be going through the entire procedure of valuation, shares and financial instruments. A security on acquisition shall be recognized at actual cost. So at the time of purchase, the actual cost, including the transaction tax or whatever it is, or sort of any commission paid, brokerage paid, etc. All those things has to be recognized at the time of acquisition, purchase, first recognition. Then the actual cost of security shall comprise of its purchase price, include acquisitions such as brokerage, fees, tax, duties, cesses, etc. Security is acquired in exchange for the other security. The fair value of security so acquired shall be the actual cost. Say we are exchanging company A security with that of company B security, then the exchanged securities fair market value should be the deemed actual cost value for this security that we are purchasing. Fair market value of the security exchanged. Whereas security is acquired in exchange for another asset, the fair value of security so acquired that shall be the actual cost. Asset if you are doing that, fair value of that asset should be the value of this actual cost purposes. Then where unpaid interest has been accrued before the acquisition of an interest bearing security as is included in the price paid for security, the subsequent receipt of interest is allocated between pre-acquisition and post-acquisition period. The pre-acquisition period of interest is deducted from the actual cost. We know come interest, X interest basis. So if there are some interest bearing securities, we may be knowing some interest would have been accrued, but would not have been due. Say, for example, the interest is going to get due in 6 months, and within 3 months we had purchased. So out of which, now if you are purchasing that security, 3 months already the amount should have been accrued there. So that amount which are being accrued till that purchase, till the amount being due, that amount of in between interest has to be reduced while evaluating the cost. Say, for example, 1 lakh rupees security you are purchasing, 6% is the interest for 6 months, 1% per month. After 3 months of interest accrual, you had purchased the same. So it would be 1,03,000, the total cost at the time of purchase, presume. So in that case, 1,03,000, 1 lakh the security price plus 3,000 would be the interest. That 3,000 is nothing but come interest. At the end, you would be receiving 6,000 rupees as interest. At that time, that 3,000 rupees already that you had in that security should not be taken into account while evaluating the cost. That 3,000 rupees has to be excluded. Come interest, not possible. You have to exclude what interest portion in order to value for that cost as per se the standard for shares and financial instruments. Hope I am clear. Then this is how you have to get the value at the time of purchase. So in short, purchase should be at the time of initial recognition. The cost of purchase should be included, purchase cost along with the acquisition charges such as brokerage fees, tax, duties, excess, etc. You have to add. In case of exchange also we were mentioning, then interest bearing security, that accrued interest till then has to be decreased. Then after recognition, our duty lies those securities which are at the end of that year. So here, for that purposes, the standard prescribes that at the end of previous year, the securities held as stock in trade shall be valued at actual cost initially recognized or net realizable value at the end of previous year, whichever is lower. So the standard also, if you go by the language, ICDS 2 is in par with this ICDS for valuation of shares, etc., financial instruments, etc. But the point is how to value the cost. Only there are certain distinctions due to nature of industry. There would be differences. These are all financial instruments. So in that case, the formula being same, but the values as per those ICDS different standards, there would be some distinction in valuation. So here again, the cost, as we mentioned earlier at the time of purchase, or the net realizable value, market value less the expenses to make it sold, we would be deducting that amount, whichever is lower shall be treated to be as that amount of value of stock that has to be reported. That's how this standard also makes us to know. For this paragraph, the cost initially recognized and net realizable value shall be done category wise. We were mentioning as if in ICDS 2, item wise we have to do that exercise. For this purpose, security shall be classified into following category: shares, debt security, convertible securities, any others. This way we will have to divide, and share wise, item wise, we have to find out the cost as well as this net realizable value. Net realizable value par with that of earlier standards, the amount that it is going to estimated to be sold less expenses in order to sell the same. That amount would be net realizable value. That amount of net realizable value has to be compared with the cost. For this purpose, the cost should include this thing, initial recognition cost we were mentioning in the previous slide. So this is how we would be valuing the shares, debentures, etc. for the purpose of this ICDS standard. Then here ICDS, here also there is mentioning about the opening value. The opening value, just as if in ICDS 2 standard also, the value of securities held as stock in business as on the business beginning of the period previous year shall be the cost of securities available, if any, on the day of commencement of the business, and the business has commenced during the previous period. The value of securities of business as on the close of immediately preceding previous year in any other case. So the opening balance, the closing balance of the previous year shall be the opening balance of this year. If it has been started this year, then only the cost at which it was been acquired. Say, for example, some in ICDS 2 also, say some business entity has been started by acquiring some other entities. So their value of opening stock should be valued as per ICDS, and that should be presumed to be the value at which you are going to start the business. So that value in case of beginning of business, in case of going concern which was been there in the previous year also, then the immediately closing figure shall be the opening figure. Nothing new here too. So this is how it has to be valued for shares, etc. Then now on to the third exclusion. So among those exclusions, contract sort of a thing, work in process we had covered. Shares also we had covered. Now on to the third element. Third exclusion there in ICDS 2, agricultural produce, livestock, etc. So here the peculiarity in this ICDS standards are there are no specific standard in ICDS dealing with these agricultural producers, livestock, etc. So here, but if you go by Ind AS standards, in AS2 also there are no such standards on agriculture, livestock, etc. But in Ind AS, yes, there are specific standards which are dealing how to do with these agricultural producers, livestock, etc. As any other ICDS are silent with regarding to value this thing, in ICDS 2 itself, at the time of exclusion itself, there is a mention with regarding how to value the inventories of livestock, agriculture, forest products, mineral oils, ores and gases. So again, do I repeat? In any other ICDS standard, if you go by right from ICDS 1 to ICDS 10, there are no specific standards to deal with livestock, any other agricultural producers, etc. So definitely, for sure, the standard ICDS 2 itself at the time of exclusion itself have given how to value the same, and the standard says the producers of inventories of livestock, agriculture and forest products, mineral oils, ores and gases. So the point is the producers, the agriculturist or the farmer or the person who is exploring those mineral oils, ores, etc. Not for the traders, not for the persons who are going to manufacture further products using these primary products. So it is not applicable, my dear August audience, to value the trader. If a trader is dealing with these producers, this may not be applicable. The producers of this inventories for livestock, agriculture and forest products, mineral ores and gases. So again, do I repeat, it is not the person who is doing an intermediary production using this livestock, using these agricultural producers, using these mineral oils, using these ores or gases. For them, it may be their raw material. It would be their purchase cost. It would not be on the basis of this sentence, but only for the producers, for the farmers, agriculturists, this formula is applicable for them only. If they are going to value their livestock, agricultural, forest produce, mineral oils, ores and gases, it should be measured at net realizable value. Hope I am clear. It is applicable only for the first line producers, not for the next level of persons who are going to get the producers from them and they are going to reprocess in order to make something which is fit to the market. So this is the point that you have to bear with. The point with regarding to that, that only for the producers, then it would be treated by, it would be valued at net realizable value. We know the term net realizable value, estimated sale price minus the cost till that point of sale we have to deduct. At that net realizable value, these things would be valued for the purpose for valuing the producers. So the column is there in form 6C for these things also. So if the valuer is getting the revenue in order to value these things, you have to fill those columns. We would be seeing that form 6C, that table respective we would be discussing later. Then comes next exclusion. Next exclusion is with regarding to machine space. So machine space, there are specific mention in ICDS 5 regarding to tangible assets. Therein, standby equipment and service equipment are to be capitalized. Machinery space shall be charged to the revenue as and when consumed. So if we are purchasing machinery space we know small parts, small things which are being used as either consumables or small parts which are there. It can be general spare parts as well as specific spare parts. So if such machinery spare parts are being purchased without capitalizing them, So it should not be added along with the assets as such. So if there are such machinery space purchased, it should be directly charged on to the revenue. Thereby, there is no question of making it to be part of inventory. So whether all the machinery parts would be charged to revenue. So whether there is the presumption the machinery spares would not be there for the valuation of inventory purposes. The answer is when such spare can be used in connection with an item of tangible fixed asset and their use is expected to be irregular, then they can be capitalized. So only when it is been used for the purpose of a specific machinery, then it would be capitalized. That too, it not be shown as what this sort of thing. So you presume which point inventory would be arise in order to get credited in their profitability statement. So definitely yes. In second situation wherein if you are having that tangible fixed asset added along with or the value of space added along with this tangible fixed asset, then there is no question that something which has been revenue has been done there. But here in second instance, if it is a general space, then only comes the point that it would be at the time of purchase, you would be putting it in under the what do you call the debit side of profitability statement, expense part of profitability statement. Then if any which are being not been consumed during the period would have to be capitalized, would have to be capitalized, would have, sorry, it has to be inventory form that has to be mentioned under that spare column. So there the distinction has to be taken whether if you are going to capitalize it, if it is been capitalized, then there won't be any question. But if there are something which are being purchased, which are not being used for the purpose of production or for the purpose of machinery space, which are intact to be used for the purpose of general purposes, not for specific purposes, that machine space alone would be required to be credited as part of inventory. So this is about the next exclusion. And the final one was with regarding to discussing the borrowing cost. This is not about the exclusion part. The exclusion part's already over. Every exclusions mentioned in ICDS2, we have made it clear. Now there were various mentioning about the term borrowing cost, when and where such interest cost, when and where such borrowing cost to be included under inventory valuation. We have to mention right now. For all those purposes, I was mentioning qualifying asset concept. So definitely, yes, you have to know the term qualifying asset first. Then only we would be getting to know how this borrowing cost would be capitalized, would be added along with the value of such assets, not directly debiting it in the profitability statement. So the borrowing cost has to be defined in ICDS 9. Borrowing costs are interest and other costs incurred by a person in connection with borrowing of fund and include commitment charges on borrowings, amortized amounts of discount or premiums relating to borrowings in case of bills discounted, etc. Amortized amount of ancillary costs incurred in connection with arrangement of borrowings. Why it is amortized amount only for that period and not the total amount which are being in discount form for that period itself, how much it would, that amount would be taken as borrowing cost. Then finance charges in respect of assets acquired under finance lease or under other similar arrangements. We know operating lease, entire amount would be treated par with rent, but in case of finance lease, the total amount of financial lease payment, something would be allocated towards principal amount and the remaining towards the finance charge. So in case of finance lease, that interest charge also would be forming part of borrowing cost as per this ICDS 9 standard. So all these interest amount, all these commitment charges, all these discounts, premiums, ancillary cost, etc., would be under the term finance cost, borrowing cost. And this borrowing cost, next term being qualifying asset. The term qualifying asset means land, building, machinery, plant or furniture being tangible asset. Though out of purview of inventory valuation, all tangible assets can be a qualifying asset. Know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature being intangible assets. So almost all intangible assets are also so-called can be a qualifying asset. So apart from those long-term assets, Apart from those non-current assets, current assets in form of inventories. So inventories that require a period of quite important. Inventories that require a period of 12 months or more to bring them to a saleable condition. So in such cases only, that inventories, my dear August audience, my dear professional attendees, the inventory should be a qualifying asset. When and only the inventory would become a qualifying asset, then the borrowing cost that we were mentioning in the previous slide can be added, can be grossed up, can be included while valuing the inventory. So that point, when such inventory would become a qualifying asset, such inventory would become a qualifying asset. Such inventory would become a qualifying asset when such inventories are requiring minimum period of 12 months or more to bring them to a saleable conditions. We know there are certain products which do take time in order to become an inventory. Classic example, wines, etc. Or in case wherein you are making some machineries and all, it may take more than a single year to manufacture that a machine or that a product. So in such cases, if the total time devoted to make that in its finished form is more than a year period, 12 months period, then that interest up to that period can be included along with inventories, and such interest devoted towards this inventory preparation, manufacturing would not be treated as a revenue expense. It would not be directly debited. It would not be directly shown as an expense in your profitability statement. Hope I am clear. So the point being, when only the inventory that the valuer is going to value requires more than 12 months in order to make it to a saleable condition, interest availed specifically for that purpose, apportionate towards that purpose, borrowing cost can be capitalized. For any other assets, if it requires less than 12 months in order to convert to those finished saleable condition, then such interest has to be directly debited to P&L account. Otherwise, in case wherein such inventories do have this characteristic, then only you can add it along. So there, borrowing costs that are directly attributable, I was mentioning, then other borrowing costs in accordance with the provision or apportionment also we would be required to give it. So this way, if such inventories, only inventory part I am trying to discuss here. So if such inventories that are requiring more than 12 months or more to bring them to saleable condition, then the borrowing cost specifically or apportionment for those inventory you can add it along with the valuation of inventory. Otherwise you cannot. So this is what about borrowing cost is. Borrowing cost is. Hope I am clear. So with this, the standards, ICDS 2 we had covered, plus we had discussion with regarding to some other standards. Some other standards with regarding to construction, with regarding to borrowing cost, with regarding to agriculture, everything we were discussing. So after discussing all the standards intact, now let us move and some questions are being appearing in the comment box. Yes, we would be definitely going through those questions later. But anyhow, when and there, definitely yes, you may feel free to put your queries in the comment box. Question and answer box would be rightly available there. So after discussing ICDS 2 standard, after discussing the exclusion parts, now let us move on to have a case study. How to value an inventory as per ICDS. Hope one statement is appearing there. Is it visible?
Yes, sir, it is visible.
Yes. Yes. So here we are trying to get that ICDS sort of valuation for an industry and the product being MS ingot. MS ingot. MS ingot, for getting that term familiarized only, I'm telling. Yes, some among the attendees would be having that knowledge about the same. MS ingot or billet is an intermediary product that is being used in order to manufacture thermomechanically treated steel bars, TMT steel bars. These MS ingots or billets are being re-rolled in order to manufacture these steel bars. So in a concern who are manufacturing this ingot, how to do this exercise of ICDS valuation, we would be going through. So practically, if you are being assigned in order to value an inventory, the steps to be followed we would be discussing. But anyhow, the first and foremost step that you have to follow is you should know the industry. We should know how the manufacturing process happens. What are all the ingredients? What are all the process plan? How the process are being done? Various stages of production, everything. We should have a bare idea without which we cannot value that inventory. So here, how these MS ingots are being manufactured? These MS ingots are being manufactured with, here in southern part, we using scrap. Only these ingots are being manufactured. In case wherein there are iron ores, primary steel manufacturers, to have got that access to iron ores, from that ore itself, the steel alloy are being made. Anyhow, in these parts, iron ores are not there, southern part of the country. So here it is a secondary sort of a steel. It's not a primary steel. Anyhow, they do make, they do produce, they do manufacture these ingots using scrap as primary raw material. Scrap along with sponge iron, ferrosilicon, silicomanganese, plus some other consumables. It would be onto a high temperature furnace, hot furnace it would be, within which those impurities would be taken away. Then it would be onto an mold within that plant. Within to that mold, after a period, it would be turning out to be an ingot. So that ingot would be further used in order to produce steel bars I was mentioning. Anyhow, so here in this instant factory, if you are getting an assignment to do, then the finished products would be MS ingot. There would be something which would be in work in progress. There would be something in form of raw material, something in form of spares, in form of consumables, etc. So how to do, how to value the stock, we would be discussing. So for that, the first and foremost thing that we have to decide is what method that we are adopting in order to do that exercise. So in order to value this MS ingot, presuming FIFO method, first in first out method is being adopted. The first thing that you have to decide is out of the raw materials, how much quantity is in stock. Say, for example, I am telling MS scrap being the raw material. From that MS scrap raw material in hand, on daily basis, you would be issuing in order to manufacture MS ingots. And finally, say on 31st of March 2021, for this instant case study I had took, this is actually an actual cost statement. So for that 31/3/2021, there would be physical stock of raw material MS scrap, mild steel scrap, plus some raw material in form of MS scrap would have been issued to MS ingot, and that portion of MS steel would be within, MS scrap would be within that MS ingot too. So say for example, MS steel I was mentioning, scrap I was mentioning. Here you may see on 31st of March, suppose you are having 182 tons of MS scrap within your hand. You have to go back. Every purchase you have to go back and you have to see this MS scrap 31st March value has been taken from last purchases. Yesterday we were evaluating how to do with various methods and we were having illustrative examples for valuing the inventory both for FIFO method as well as weighted average method. I do hope the August attendees would be recalling back how we were doing it as per FIFO as well as weighted average. For this case study basis, I was mentioning we would be taking FIFO method for valuing the inventory. For that sake, I was mentioning again, I do repeat, if you take a single element MS scrap, then that MS scrap as such would be in its raw material form. And that value of MS scrap, something would be in MS ingot in closing stock form also. So how to get those figures, how to get those values as per FIFO method. Here you may see per ton value, almost everywhere it is 27,500 only. But if it differs, how it can be, we would be seeing. Here as I was mentioning, total raw material stock of raw material in hand as on date was 182.15 of 515. So backward if you go till this date, it would have been there. It's the fundamental presumption of FIFO. So closing stock of raw material as far as MS scrap is concerned, you may take on this basis. Then you would be knowing how much has been issued. You would be having that input output ratio. How much MS scrap is required in order to manufacture a single ton of ingot, you would be knowing. Here in our example, we have 249 metric tons of MS ingot. So in order to manufacture the same, how much steel scrap is required? Again, we would be requiring to go back. So input quantity for closing stock of MS ingot, backwise also we have analyzed, and that value also we had to get here. So in this way, every material we would be required to take every material in its closing stock form used for manufacturing, which are being under inventory. Here you would be getting sponge also we would be getting. Likewise, silicomanganese you would be getting. So in this way, we would be required to take this closing stock in hand with that of that amount which are being put in for manufacturing MS ingot. So this way, first of all, you have to segregate the raw material as such in form and the raw material consumed in order to do it. If there is a SAP software directly doing all these things, yes, you may take those things provided that internal control, everything is being proper after your due diligence. Those figures you can. Otherwise, mechanically, you can also take those quantitative details. All those quantitative details, we know we are costing people at the time of preparation of cost audits and all. We know how to take those quantitative details. So every issue of those inventories daily basis you have to take in its raw material form and in its those raw material converted onto its finished goods form, also this thing we would be required to get evaluated. So in this way, we had segregated all types of raw material. Then those raw material I was mentioning, apart from those raw material as such in hand, those raw material used for the purpose of manufacturing those ingots which are in hand. I was mentioning mild steel. There are 91.05 metric ton amounting to 25 lakh. So that value we had put it here. In case of heavy melting scrap also, same principle, same formula. We had put it here. Apart from this closing stock used for manufacture, this 122.450 metric ton, 36,100. So those amount we had plotted along with this thing. And we know for sponge iron, ferrosilicon, silicomanganese, every point on the basis of that estimation, we had put the respective values, both quantitative values as well as the amounts. Then we know as per ICDS2, it has to include the GST portion also. So this is GSTable commodity, the rate of tax being 18%. So that amount of 18% also has to be added in order to get the total cost of purchase, which is being included in order to value this 249 ton of MS ingot. Then for this industry, there are certain scrap again. Scrap of this commodity being termed as runners and rises. It would be again used in order to remelt. Anyhow, yesterday also we were mentioning in case of byproducts and all, those scrap value, it has to be directly deducted from the material cost we were mentioning. So here on that basis, we are taking a market value for this runners and rises manufactured during the period, and that amount also we would be deducting from the total cost. Then apart from this material, there are various consumables. Same method used for materials. The amount which are being in stock as closing for the specific raw consumable, it would be excluded. Backwards would be calculated, and we will be getting the value for consumables. Same this thing per day units consumed. How much days production is this value 249.085? You can evaluate on that basis. If that power sort of things we are having, then we can easily identify the power cost which would have been there. Apart from the normal power cost, we are having that fixed sort of charges to be paid for electricity also. So on the basis of fixed overhead proportion that we were mentioning yesterday, par with normal, lesser than normal, how to do it, more than normal capacity production, how to do it. Yesterday we were discussing. On that basis, fixed portion also we may require to allocate it here, plus total actual cost incurred, actual electricity consumed for this power plant, for this plant in order to manufacture this closing stock also. Days, how much it would take in order to manufacture this thing, we can take it from finished goods stock register. This much for 249, how much days it took in order to manufacture. Backwards before again we can go. Power charges also we can. Then labor charges also, just as if the number of days required to manufacture MS ingot, we can get 249 ton ingot, we can get it from that stock register I was mentioning. On that basis, that amount of labor payment, actual variable labor payment we would be getting for specific days. Fixed labor also I was mentioning, supervisory charges, etc. On that basis, again, we would be required to get with, plus any other direct expenses also we may require to do it on the same basis. Apportionment on the basis of how much days it took in order to manufacture this MS ingot of 249 ton we would be getting. Then after going through all the labor, power, consumables, etc., some other overheads which are having direct attribution, to do this. Administration cost we are not including, but we were mentioning if finance cost is includable, then that also we can. Then direct administration expenses, if any, that also we can. Depreciation also we can. In this way, the overheads also we would be adding. Then after adding all those expenses, if we are having abnormal loss. What is this abnormal loss? Yesterday also we were mentioning about the same. We were also mentioning about this. The abnormal loss, etc., we would be required to exclude while valuing the inventories. This is an basic school of thought we know in costing. All the abnormal items should be excluded while calculating the cost of production. It should be separately and specifically debited to profitability statement. That fundamental principle, notion we know. So how to calculate? How to calculate this abnormal loss? How to calculate this abnormal loss? For which we have to again go back to our fundamental process account. Process account we have to. So here in this instant case, total direct material for this inventory alone, not for the entire period I am trying to take. For this inventory alone, I am trying to get with. So we know the total raw material inserted here amounts to, if we gross it up, 282.720 being the total quantity. So that amount, after that, this thing we would be putting here. The rate also we would be on that basis, total raw material cost we would be getting. Along with which we would be adding up the power and labor charges plus overheads also we would be adding. Then this critical table speaks about the total quantity. Say here it is 305 being the total quantity of raw material consumed. If you go by, out of which, yes, this 305 we are having standard input output norms, SION, standard input output norms issued by Director General of Foreign Trade, DGFT. So DGFT issues standard input output norms. So for almost all sort of manufactured products, the DGFT has issued that SION norms. So quite a relevant, quite an important point that all the valuers have to keep it in mind. Definitely, as at the time of performing cost audits also, we may have came across with those standard norms. For export purposes, how much should be the input, how much should be the output? That input output ratio are being prescribed there. And if you go by, as I mentioned, this ingots, MS ingots, there is also that input output norms as specified in that DGFT statement, wherein here for those non for primary steel MS ingot, here it is secondary sort of a steel only. So I was mentioning it would be manufactured from steel scrap. So for that purpose, the ratio mentioned there would be 1.08810 is to 1 ton of ingot. So that is their standard input output ratio. So from this raw material consumed, it is expected to manufacture 280.31. So differential portion would be 24.69. That would be the normal loss. But here the actual output only is 249, and thereby the differential portion, it should have been this 280.31, but we got only 249.09. So the differential portion would be abnormal loss. So this would be abnormal loss. While preparing process accounts in our elementary days, definitely as we know how to calculate the value of abnormal loss and all. So for this steel sector industry also, I am calculating this abnormal loss raised due to so many other reasons, maybe due to inferior quality of raw material, whatever it is. This CA norm, whether it is acceptable, yes, it is. For central excise valuation purposes, CAs for valuation purposes, that rule 8 for CENVAT rules and all, it was not CENVAT rules, for those valuation rules and all, it was there, cost of production plus 10%. So all these CA norms were being accepted by the departments as well as the judicial authorities in order to take this input output ratio. So with that input output recognized ratio, we may calculate that abnormal loss. Again, do I repeat? Here the total quantity inserted is 305.5. Using this input output ratio, then the total output should have been 280.31, but we got only 249. So the remaining portion would be treated as abnormal loss. So that abnormal loss we would be valuing here using the same formula. How much it was for the normal product, same value we would be calculating here too. And that value of abnormal loss we would be deducting. We would be deducting here at final point, we would be deducting, and it would give that value to be deducted from there. Abnormal loss would be deducted from this value. And the total TMT rate we would be calculating here. So this is how we would be doing it for the purpose of ICDS2. A normal simple example. One thing that I had already done are been illustrated here. Any doubts in this case, definitely as you may feel free to ask. So a small thing that I want to make to assure is you should know as a valuer what type of industry it is. On that basis of industry, how the process is being done, how that manufacturing process is being carried out, you should know stage by stage, you should know. Then only you would be getting the idea to value those inventories. So here for valuing for ICDS2 purposes as a cost accountant, definitely yes, you may assist the assessees in order to do it. Apart from this thing, we have now got this opportunity in order to go for this 142 valuation. So this is not an permanent matrix. This is an dynamic one. Definitely yes, it can be changed on the basis of industry to industry, product to product. So this is a bare idea about how to value the inventory on the basis of FIFO. So for that FIFO, again, do I repeat, for that purpose, raw material in hand as such, along with that being utilized for the purpose of manufacturing that final product has to be segregated on daily basis. Then period cost as such in labor sort of a thing or power sort of a thing. Definitely yes, you have to get it on the basis of the total number of days or time devoted in order to get that closing stock in your hand. So this is how that manufactured output of finished goods MS ingot would be valued. Then for raw materials, consumables, etc., as in hand on the basis of FIFO method I was mentioning, how to value it. So this is about the computation of inventory, valuing the inventory MS ingot in this instant example. So after discussing this MS ingot example, now let us move on. A lot of questions are being there. We would be coming. So after discussing this case study, we are going to discuss with Form 6C. Form 6C. So all this exercise. So Form 6C is now visible. Form 6C.
Yes, sir. Visible.
Yes, Form 6C. So this is the report that we, the valuer, is supposed to submit before the income tax authorities. This is draft 6C. Again, do I repeat? So any recommendations, any suggestions to be given by the members, you can definitely share either through the institute or directly to the income tax department. So herein, what are all the precautions that the cost accountant have to do, for which we are going through that Form 6C. So this is a basically one report along with annexure of tables. So as if our cost audit report, any other income tax audit report or any other audit reports. So there is a column wherein we are certifying, we are confirming the values. So here Form 6C, Rule 614A E form. So it has to be uploaded on electronic basis. Inventory valuation report under clause 2 of section 142(2)A of Income Tax Act 1961. So our reporting paragraph starts here. I or we have examined the inventory of the name of assessee, address, PAN, asset so and so address. We have conducted the inventory valuation in compliance with the requirement under relevant provisions of Income Tax Act 1961 and Income Tax Rules 1962. So definitely yes, we have to undergo valuing the inventory in par with ICDS standards 145A, etc. The opening inventory, how much we have valued, this much. Closing inventory, this much. So normally a single year we would be getting that revenue in order to value. So for that year, how much the value of opening inventory is, closing inventory is. This should be our valued values. It is not as per their books. It is not as per their inventory reported at the time of filing their returns. But this is the value which is valued by the cost accountant, the valuer there after the assignment. I have obtained all the information. So whether we have got that information or not, definitely yes, we may report it there. If not, we may give a disclaimer opinion. In my opinion, the proper books of accounts with respect to inventory have been maintained at head office and the branches of the assessee. visited by us. So definitely yes, physical visit is necessary. But in your office, you cannot. You have to visit the assessee and you have to do it. Then again, whether there are the provisions wherein we can have the physical verification that the days has to prove that the clarification actually we should get. I'm also not having that an idea whether we are having that avenue, whether we should physically verify those things or not. No idea till now. Yes. So that visit is must by my or our examination of books and proper data adequate for the purpose of inventory valuation has been received, except so and so. So what are all the disclaimers? Which are all the things that you didn't get? You have got that column in order to mention it, 1, 2, etc. Then, in our opinion, the information and according to the explanations, the inventory valuation presented here is appropriate. The prescribed particulars. Now the column is with regarding to the income tax department order, income tax department proposal in order to give that this thing with the DIN and all. So that should be mentioned in the next paragraph. Then any variation observed, that is a critical point. So you had valued. If that value is in par with that which has been returned, the inventory which has been mentioned in audit report on which the tax has been paid, if there are no variations, then there's a clean report. But if there are any variations, if you value something different, maybe higher one, maybe lower one, both opening as well as closing inventory, then that amount we have to give a memorandum statement, reconciliation statement. How that reconciliation statement would be, this is as part of the annexure we would be discussing. So in short, this is the purpose for which we are doing all these things. So all these things should result in reporting in form number 6C in this pattern. Roughly I am going through. Then annexure number 1, inventory valuation, information of assessee, general particulars, name, address, date of incorporation, details of principal products, details of books of accounts maintained by respect to inventory. So what are all the books of accounts, methods adopted? Then you may see all these things you have to give in specific. For finished goods, stock in trade in case of resellers, traders, work in progress, raw material, byproducts, intermediate products, jigs, tools and dies, stores, spares and consumables, scrap separately we would be required. Then second one, state whether there is any change in method of valuation and aforesaid compared to that method in the immediate 2 preceding previous years. So apart from the current year, here also in 6th point we may see not only for the current year, to respect to 2 more previous years we would be required to give the report by. Then if there are changes we were mentioning, there are changes, then what was the reasonable cost? So what were all the reasonable costs? In order to change the method, FIFO to weighted to specific identification, some method of valuation have changed, techniques of valuation have changed. So what was the impact? All those things not only pertaining to the current year, but also with respect to 2 immediate preceding years, we would be required to get with. Then after getting the same financial particulars, turnover up to that average finished goods, all these things would be directly available. Then again, the only peculiarity is not only for the current year for which it has been assigned, also for 2 previous years too, we would be required to do. Then details of raw material description, the name. Here the point is how much, suppose they are having numerous types of raw material, whether every raw material has to be reported. The note says inventory of all such types constituting up to 80%. 80% of the same definitely yes, we would be required to report. So those out of total raw material, that major part, lion part, 80% of the number of items of raw material we would be required to report it here. The raw material name, description, unit of measurement, kiloliter, where megawatt, whatever it is, opening stock, purchases, consumption due to finished products, raw material sold as such, closing stock, shortage, wastage, rejects, etc. In cost audit report also we may see similar columns too. Then quantitative details in case of a trader, similar columns. Then quantitative adjustments. Quantitative adjustments meaning if there are any changes, maybe due to spoilage, wastage, etc. All those things also we would be required to give it there quantitative wise. Then has the assessee conducted physical verification of raw material stores and finished products, etc., or the goods dealt in the above? Assessee has conducted. Has the assessee conducted meaning we are not conducting. So on that specific date, whether on the basis of book stock alone we had done or physical verification done, and that reconciliation with that physical verification with book stock, whether it has been done or not, is the question. So in such cases, whether there were any discrepancies is the 10th question. So again, there is no clue that the cost accountant have to do that verification. This physical verification is about whether the assessee has done it on that final date, closing inventory date, whether they had done it or not is the question. In such case, whether there were any discrepancies with book stock with that of this thing, all these things would be there. Because now after this audit trial being implemented, we are all know definitely yes, I do think that everybody knows about that concept audit trial. Now right from 1/4/2023, every company who is having their books of accounts to be maintained with electronic form, in electronic form, with computer softwares, computers, etc., are mandatorily required. Companies are mandatorily required to initiate that audit trial option in their software. So about this audit trial, any change that would be duly recorded in that edit log window. So who has changed it? What was the change? What was the things before? What was the change? What was the things after that change? Everything including date, time, etc. would be captured in that audit trial. So anything which were being made definitely yes, as a cost accountant, as a valuer, definitely yes, we would be having that access to software. Then we have to take that edit log also in order to verify any malpractices are being made, any changes are being made. So if you find something which has been fishy in nature, definitely yes, that can be also reported here. Anyhow, the point is audit trial, definitely yes, even though it's an audit trial, it's actually an accounts trial. Anyhow, the auditor would be getting that opportunity to find whether there are any changes in the books of accounts which doesn't prima facie appear in the books of accounts. Then after 10th point, 11th one with regarding to 145.2 ICDS standard, whether it is in conform with ICDS 2, if not, the reasons or the discrepancies, if any, you have to report it separately. Then now comes stock wise inventory valuation that the valuer have to do with. Details of inventory valuation for the year under report by cost accountant, ICDS 2, valuation of finished goods or stock in trade. Here the description, again product wise we have to do, item code, then unit of measurement, opening stock, closing stock, quantity, COP, NRV, whichever is lower. So cost of production or purchase value in case of trading goods, NRV, net realizable value, lower among 6th or 7. We know the formula. The value, quantity multiplied by lowest of 6 or 7 we have to take. So the same has to be followed for opening stock as well as closing stock. So here we can add or delete the window, what do you call it, the rows. We know it's an electronic form, just as if now we are uploading certain forms, we would be getting, we are expecting to get that form 16 electronic form in income tax web portal. Now it is not possible, it's a draft form only. Now, after this finished goods or stock in trade, same for work in progress, same quantity, cost of production, NRV, lower for opening stock as well as closing stock we have to. So this is for ICDS 2 applicability. So ICDS 2 applicability, first one finished goods we had, stock in trade we had, work in progress we had, same raw material also we had. Then byproducts. Yesterday we were discussing how to value those byproducts. Here the net realizable value byproducts we would be getting, not that this thing we would be, because this net realizable value would be deducting from the total value of cost we were discussing. Anyhow, if it is in by what do you call in stock, yes, we can have this thing be valued at net realizable value only. Here the cost concept is not there. Raw material byproducts, then intermediary product. Intermediary product we know products which are in form to be converted to finished goods, but in its now form itself, present form itself, it can be sold as finished products outside. But this is an raw material form which is applicable in order to manufacture the final products here in this company. In my instant case study, ingot was being termed to be the value for which I was valuing. Supposing that industry, supposing that unit, that company is having steel re-rolling plant within that entity itself, then that ingot would be used in order to manufacture, in order to re-roll, to have that MS steel bars. So in that case, TMT steel bars. So in such cases, MS ingot is an intermediary product. MS ingot is an intermediary product. That product can be as such sold in the market, as well as it can be used as a capital goods for manufacturing the next level within that entity itself. So that intermediary product, same formula. Cost of production, NRV, whichever is lower, opening stock and closing stock we can have. Then stores, jigs, tools, dice, stores, spares, etc. Scrap. All these things, opening value, closing value, these are all negligible things. So market value or cost, both you may description also you have to give with. Then summary of inventory valuation, all these things, right from finished goods till stores, spares, till scrap, you would be required to do it. Then in case wherein there are differences meaning 3 columns. First column 3CD. I was mentioning in 3CD how it would be appearing. 3CD is nothing but the tax audit report I was mentioning. So in 3CD in that column 14th close, in that column how much it has been 145, how much it has been included, that amounts specifically for finished goods, for work in progress, for raw material, for byproducts, intermediate products, separately we would be. Then our valuation as per the previous tables we had. So our valuation also would be put in this second columns. Then variances, opening as well as closing. I was mentioning a positive variance in opening would increase the cost, would decrease the profit. The reduction in opening would increase the profit, vice versa in case of closing. Thereby, the total impact of profit or loss net we would be required to give. And on that basis, the rate of tax, if you apply, the impact of income tax also. So from this table, whether there are some income tax leakage due to valuation as per different methods or as per non-ICDS method, not by following ICDS2 if you have valued, and if there are positive variations, meaning income tax has been evaded, lower tax has been paid. In such case, definitely yes, assessing officer would proceed for the next steps and show cause notice would be issued and all the other 143 procedure would be followed in order to recover the taxes. Here again, if the assessee hasn't followed the ICDS, nor at the time of valuation, we couldn't get the information in order to do it. In 145 itself, you were mentioning if the stocks, everything are not being followed by 145.2, ICDSs are not followed. Subsection 3 prescribes that the entire assessment would be done as per best judge assessment way. 144, section 144 would be applied. So that assessment would be best judgment on the basis of assessing officers' discretions. So that is the point that has to be. So all the assessees have to follow this ICDS sort of a standard. As we as a valuer, we have to find the difference, if any, with that of their 3CD figures with that of our valuation. Profit impact in this field, we are reporting it to the assessing authorities. Then those for which ICDS2 is not applicable. Today we were discussing for those avenues wherein these are not applicable. Construction contracts I was mentioning. So in that construction contracts, I was mentioning that the units which has been completed, ready for sale. So it is not work in progress. It is units which has been completed, ready for sale. So the total cost or NRV, whichever is lower, definitely yes, we may, both for opening as well as closing. Then in for work in progress, I was mentioning it has to be valued for total day-to-day, total to date construction cost less cost as per recognized revenue. For that revenue, we were mentioning stages of completion and all we were mentioning how to take. So project wise, project 1, project 2, project 3, how many projects are there under progress, construction work in progress. Project wise, we have to take that percentage of completion and the formula for evaluating the stock being total to date construction cost less cost as per recognized revenue. The differential portion would be treated to be as value for the purpose of work in progress. So this is how we would be doing it. Valuation of construction work in progress. Then valuation of construction material itself, purchase rate or replacement cost, whichever is lower we would be. Here it is not NRV, replacement cost basis we would be required to take construction material. Then construction fitting, same, purchase rate or replacement, whichever is lower you have to. Then the total summary, completed units, construction work in progress, material, fittings, difference in 3CD with that of our valuation, variation if any, impact on profit, impact on tax. Same thing that we were discussing for ICDS 2 covered inventories 2. Then for trading of traders of security, we were mentioning ICDS 2 would not be applicable. Specific standard was there. So shares specifically, debt security specifically, we have to take. So their actual cost or NRV, both we were mentioning for closing dates, actual cost, what are all the things which are inclusive, NRV, what are all the things which has to be done, we were mentioning lower among the same. So for equity, for debt security, for convertible security, everything we would be required to do. Violation of any other security, after which same thing, reconciliation table, separate securities, shares, debt security, convertible security, any other security, 3CD value, cost account and value, variation, impact on profit and impact of tax. As if the last one, in case of livestock we were mentioning, it should be under NRV. No specific ICDS standard is there. In ICDS 2 itself, it has been mentioned, it has to be valued as per NRV. Cost is not an impact there. Net realizable value, stock wise, item wise, we have to do it for livestock. For agriculture and forest produce also NRV. Mineral oil source and natural gas also under NRV we would be required to give. So again, this is applicable for producers only, not for the traders or further manufacturers of these things. This is how this primary products would be done with. Primary products comprising of this livestock, agricultural producers, mineral oils and oils and gases. So this is the total form 6C. We were just going through the entire form. This is the form that we are supposed to submit it before the income tax authorities once it is been assigned. We would be allotted with 2 months, 3 months time also. The section 142 has been amended in such a way that the time that has been devoted to us would be excluded for assessment for assessing officers. So that time we would be getting in order to report. On this report basis only, assessing officer would be further moving for those procedures. So this is form 6C. We were just trying to correlate. This form 6C with that of the standards that we were discussing till now. Yes. So after going through form 6C, let us discuss the remaining slides. What are all the steps that we have to follow is the question. So in short, if we are getting that avenue to value, the first and foremost step that we have to do is we have to go by the financial records. Once we are there in that concern, definitely yes, the first and foremost thing that we would be required to do would be to go through the financial records, 3CD books, what type of standard policies that they are adopting, we have to verify. Then I was mentioning the industry you have to know. Why? Because the production process, complex processes are there. Without knowing the process, without knowing that production structure, process plan and all, we cannot do the costing. So to understand the industry, then knowing about the accounting policies adopted there, whether they are going for FIFO, whether they are going for specific identification, what type of it is, we have to know. Then comparing the inventory in books with that of the ICDS. So within which only we would be knowing whether the proper ICDS standard compliant figure are being given in 3CD report, whether the same inventory are being declared for income tax purposes. So comparison we have to do. Then finally we have to, after getting that cost, NRV, etc., we have to element wise, we were mentioning raw material wise, then that finished goods wise, spares, consumable wise, item by item wise, we have to find out that cost or NRV, whichever is lower. Then raw material we were mentioning, at least 80% of total material we would be required to get in order to report there. We were mentioning it there. Then separately we have to value all these things. Then the reconciliation part also I was mentioning. So this should be the basic procedure, the steps that we have to follow in order to go with that an assignment. So again, I do repeat this form 60, every table point by point we were going through. This is in a draft form. A lot of limitations are there in that draft. All those things, as the learned August audience, definitely have to go through that form 60. We do have got that practical exposure. What would be there in that industry? So any amendments, any additions, any deletions, any further changes required in form 60, definitely yes. You have to respond because it is the ball is right now in our court. We are the persons who are responsible to do it. So we have to respond. We have to make it counted. So get equipped for this avenue, long waited avenue we are getting. So we have to prove ourselves. We have to do our best in order to make further more avenues to be allotted to us. So very nice initiative taken by the tax research department. Sooner this form 6C was being issued, there was communication from TRD in order to have a session on these form 6C ICDS related standards. So I do have got an impression that almost 240 attendees are there regularly on the screen. So good number there. So thank you TRD for giving the opportunity to do this. This is all from me. Now let us move on to question and answer sessions. Last 15 minutes I do prefer to go for those questions. So if any questions left apart unanswered, definitely that would be mailed back to you also. As this is under process, as this is has to actually come by. So I don't know how much I can answer your questions at best possible way. Definitely we can go to those questions. Hope Devapradadas have mailed me the questions which are appearing on the screen. Whether it has been mailed, sir?
I am reading you a few questions and I am doing the rest. Okay.
So many questions are there.
Almost 6 to 7.
You are not audible, sir. Hello.
Sir, almost 7 questions are there.
11.
Or 7, sir. 7.
7. The first question is fees for cost accounting will be fixed by the department or what will be the basis for charge? Last question I am starting. Maheshwara sir have asked. Sir, for the current in current provisions, there are provisions for chartered accountant to go for that special audit. In such cases, the fee, everything would be determined by the department. It would be paid by the department only. So for us also, definitely yes, it would be determined by the department. There would be slabs in order to do it. We have to get empaneled first, then only we would be getting that avenue in order to call for assigned with what these cost audits, what you call inventory valuation. How cement and textile industry format for inventory valuation? I was mentioning, sir, there are specific for cost audits and all. There were specific formats issued by the institute itself. Even though it is not an permanent one, you may definitely go by those things. Then on the basis of, I was mentioning steel also, industry to industry, unit to unit, the process of manufacturing do change. So there is no specific format, you have to make it, but formats are available. Nagarajan sir. Which standard is to be followed while valuing inventory? I was mentioning it, sir, ICDS 2. ICDS 2, why? Because we are doing this exercise for income tax department only. So it is not as per AS2 or Ind AS 2. It should be as per this ICDS 2 only. ICDS 2 only. Chetan Gandhi, sir. Farooq Bhuri, sir, in Form 6C tables, items should appear in rows, not in columns. Yes, you are, sir. So that's your recommendation. Okay. That can be made, sir. Definitely, yes. Very welcome suggestion. Guidance note is not issued by institute. Yes, sir. Guidance note yet to get issued. Definitely, institute would be coming up with those. Chetan Gandhi, sir, again, CAS or Ind AS or ICDS. I had already replied. It is ICDS which is applicable. ICDS which is applicable. Slide on screen is works contract. Yes, that was a typographic error. NR Goyal, sir. It's construction contract only. It's not works contract. Sorry for the same. Apologies. You had mentioned closing stock several times, but in fact, it is consumption. I didn't get your question. Anyhow, that stock which is in closing stock, definitely as I was mentioning, raw material as such, as well as raw material within the closing stock I was mentioning. I didn't get your question in full. Balaji Narasimhan sir. That is that for that MS ingot, manufacture as on that closing stock position 249 tons I was mentioning. No, for manufacturing that 249 tons only, I had computed what cost only for base FIFO basis. On security section, ICD's inventory value will be one block number. Yes, you are. Again, your question. Scraps would also be considered under inventory and valued same. Yes, madam. If it is in stock, it can be. Usually, scrap is when it is sold, the proceeds would be reduced from cost of production. But if it is in hand, definitely yes, it has to be valued. Intellectual asset, what type of valuation to be followed? There are specific standards for valuation, sir. That has to be followed on the basis of these things. Here, the inventory sort of thing, cost of service provides us with these things, but that cost of service column is not proper. That is the question. Anyhow, definitely yes, there are chances that ICDS2 can also be revised. Institute also can come up with the various standards in order to help the members in order to do these activities. Hope so. So from my inbox, some questions I had picked. No other questions I feel. Any other points or suggestions? Definitely
Sir,
yes, you can.
I have mailed you to question. You can just look into it.
In case of road contract and any other large project cases, what shall be the stage-based borrowing cost? I was mentioning, sir, if such borrowing cost is specific for that thing, if that road project is going for more than 12 months, then definitely yes, you can capitalize, or else you can apportion too, if it is for more than a single project. In case of shared alias at the time of purchase, whether shares are not actually acquired, forward contract type, what type of treatment? Here, with the delivery sort of things are only covered here, sir. Without delivery, there is no concept of inventory as such, no. So only for those with the type delivery, I do think these standards are being covered. So this question is not applicable there. Any more questions?
No, sir. Today there are no more questions, but yesterday there were two questions that I have made.
Two questions actually. That thing actually I had discussed in between, sir.
Yes.
When
Only that.
frequency I was mentioning, it has to be done on that basis. I was mentioning. Yes. One more question I do think from Chetan Gandhi, sir. We are valuing the inventory of highly technical product. And if we are not able to understand, then we will take the help of technical person and certificate from them would be obtained. Yes, sir. That all those things as we can. We are not supposed to have that much technical knowledge for every other products, all products. Yes. On those cases at your risk, you can get the valuation from experts too. So no questions. Let us.
No more questions.
Yes. So thank you once again, the Direct Tax Department, Direct Tax Committee led by CMA V Murali sir, TRD department, all the staffs, all the attendees here to arrange such a nice session, 2-day session for a quite a relevant topic. Thank you, the attendees who are being right through the session. Thank you for your patiently listening. Thank you once again, TRD, giving me the opportunity.
Thank you for a wonderful presentation on this topic. Sir, so we can just close the session now. Hello.
Yes.